welcome to the show.
All right. What did we say last week? May you be cursed to live in interesting times.
And yet here we are.
Good golly, Miss Molly. Yep. Crazy week all the way around. But focus on the market for the week. Wednesday, we got the Fed announcement. Everybody was all happy about that. We're talking about the everything rally. Thursday, got some bad news that turned into bad news. Friday, we got some worse bad news that turned into worse bad news for the market. So it looks like we're out of this period of when bad news is good news, right? So basically bad news is good news means when the economy is weakening, it gives the Fed an opportunity to lower rates. And if the Fed lowers rates, that's good for stocks. That's the theory that we've been playing under for months and months.
Yeah.
That changed Thursday and Friday of this week.
Pretty much happening now.
So we're going to go through. So this is what we're going to talk about, right? I got a pretty good Facebook question. I thought was going to take the majority of the show, but it's not going to. We're going to go through that pretty quick. Then the Fed decision and the aftermath. Okay, that was Wednesday. Bad news is bad news again. That was Thursday and Friday. And we'll take a look at why we should have expected this to happen around this time of year because of the seasonality. And then TNX is the 10-year, the yield on the 10-year bond. So I got a chart of that and also the 30-year bond, which is it's actually the 30-year mortgage rate chart. So a lot of what happened today is going to affect in a positive way probably for home buyers. So that's a good thing in the TSP Fund charts. All right, Facebook question. So I'm retiring next June. And I can't remember, this was this week, this is earlier this week, so I don't know the details of the timing of this question, but the question came out earlier this week. I'm retiring next June, had everything in C and got nervous about losing money in an election year. So I moved to 80G and 20C. Should I change it back? I don't know when the move was from to 80G, but you know, on Wednesday, the market's way up, everything's up. So this person's saying, should I move it back? And they're saying, I need to withdraw a small portion. Who knows what a small portion is, but I need to make some withdrawals in retirement. Okay, so retiring next June, retiring basically.
Yeah, because a small portion could mean $20,000 to some people and $200,000 to others.
Yep.
You know.
Is that you? Is that me? That's interesting. Siri is...
Yeah, you guys can't hear this, but Jerry's phone just went off the reservation.
Whoa, I don't even... Holy jeez. Wow, that was crazy. All right.
Siri's always listening to us.
I didn't say Siri, did I?
No, you didn't, but she's always listening.
Invoke her name, did I? Oh, boy. Let me get back on track here. All right. So you're retiring next year. The first thing, if you get nervous about losing money in an election year, election years tend to go up. They tend to go sideways to down going into the election, right? The summer correction period. But then the last couple months of the year, almost always the market rallies. Almost is the key word. The bottom line is if you can't afford to take any drawdowns, the C fund is the only place the G fund is the only place to be. If you want to measure that with, I want to have gains and I want to have some risk management level, then yeah, what you're doing is some percentage of G and some percentage of C makes sense, right? But certainly the portion that you need to withdraw after retirement, I would argue should be in the G fund, right? So we got a bunch of pretty good answers. These are the ones I would say I like the best, but they give me something to talk about. So someone says, look at the history of the C fund in an election year, all of the years since inception, and study the G fund. So that's the thing. That is what you want to do. You want to actually don't just randomly ask the question what people think you should do. Actually take the time to look and see what the C fund does during an election year and what the G fund does. And so consider your options, make an educated decision, right? That's absolutely what you should do. It appears the C fund earns 11% a year overall and the G fund between 2 and 4%. Yeah, I mean, those are fine average numbers. Another person says, if you're afraid, then G. Yeah, if you can't sleep at night because you're worried about having money in retirement, the G fund, you cannot have a negative quarter by statute. The G fund can go down. and we're going to talk about that probably a little bit later, but with today on Friday, the 2-year yield collapsed. And the 2-year yield basically governs the G fund. And so as yield goes down, your rate of return in the G fund goes down.
The 2 or 10?
Well, 2 is the short
Sure.
is the short one, right?
Yeah.
So it's not quite the 10-year, it's not quite the 2-year, but the G fund, the F fund tends to be run more by the 10-year, the G fund more by the 2-year. So next person says, my fear is not having enough money for retirement. I'm all about CNS funds. I'm all about the CNS funds too when the market's going up, but not when it's going down. And I'm already retired and I don't have enough for retirement. So I'm all about the CNS funds, but not when the market's going down, right? Another person in a similar situation, right? I think I'm going to put the amount that I don't want to lose in the G fund, which makes sense. Keep the rest in C. Okay. Because that's the amount you're willing to risk. The amount I don't want to lose will be the minimum amount I need to retire on, probably half the balance. Okay. Yeah, that's good. You have a plan. This is a good one. The G fund doesn't cover inflation. That's generally true. The point of all this at the end of the day is to have more buying power in retirement, or have enough buying power in retirement to get you through. If all your funds are in the G fund and you're losing buying power to inflation, that's not where you want to be. You know, think of what things cost 20 years ago and what they will cost 20 years from now. 100% true. So this person's ADC 20G, but all of us, if you're a government employee, you got your pension and your Social Security. And then the last one, 1,000% to help you sleep better at night. Go get a financial advisor, preferably a fee-only financial advisor, because you don't want someone selling you another annuity or something else like that in retirement. Get a fee-only financial planner that will help you go through your personal circumstances and risk tolerance, and figure out what the best decision is for you. Okay, so hopefully that there's some good answers to that question. All right, so we're just going to go through Wednesday, Thursday, Friday of this week, and it was a crazy week. So the Fed comes out on Wednesday afternoon and says they're going to keep rates the same, but they basically said they're going to start lowering rates in September. Okay, so I think it's September 21st is the next Fed meeting, so it's pretty far out. So everything rallies, except Bitcoin, much to my chagrin. But Bitcoin didn't rally, but everything else, right? NASDAQ's up 3%. Now, the NASDAQ was already pretty far oversold in the past 2 weeks. So it had a pretty good recovery rally that day, up 3%. That was good. S&P was up more than 1.5%. Gold was up. Copper was up, which is big because for copper to be up, it's a good sign for the economy. And then the long-term treasury bond, so like the TLT, and the F fund. So everything was up, right, except Bitcoin. That was Wednesday. Everybody was all happy about that. And this is what it looked like with the 11 sectors. So you get the S&P 500 and then all the sectors within the S&P 500. So tech, right, was up over 4%, right, was back to where we were before, where the big cap tech is leading everything. The C fund way outperformed the S fund on Wednesday, which I thought was really odd, because now the Fed's definitely cutting rates. Everybody knows that when rates go down, small caps tend to outperform large caps, and so when the C fund was pretty much doubled the S fund that day, it just kind of made me wonder. And the F fund also went up, so something was not right. But Wednesday was great for everybody if you're just looking at the headline numbers. Thursday morning we get ISM Manufacturing Index. It drops to an 8-month low, right, for the 4th month in a row, and it dropped to an 8-month low. So ISM Manufacturing Index is a huge indicator of what the economy is doing. It's manufacturing in the United States. So a key barometer of U.S. factories fell in July, 4th consecutive month, and hit an 8-month low, a sign that an ongoing slump in the industrial side of the economy has deepened. ISM index slid to 46.8 last month. Anything below 50% on that metric means that the economy is shrinking. So the Timothy Fiore, the chairman of the survey, says U.S. manufacturing activity entered deeper into contraction. Demand remains subdued as companies show an unwillingness to invest in capital and inventory due to current federal monetary policy and other conditions. So he's saying until the Fed starts cutting rates, manufacturing is contracting. ISM reports on manufacturers and service-oriented companies offer a window into the health of the economy. And interestingly, economists polled by the Wall Street Journal had forecast the index to rise slightly this month, but it actually shrunk. So that whenever it misses, that's a bad thing too. It's below 50, that's bad. And when it misses Wall Street expectations, that's bad. So Thursday, the market was down a little bit, quite a bit, actually. Let me finish this part. So the key details out of that report, I'm not going to worry about that. The big picture, industrial side of the economy is unlikely to gather steam until the Fed cuts interest rates. High borrowing costs have sapped the economy and curtailed demand for manufactured goods. Looking ahead, it seems that the economy is slowing down significantly. Okay, demand continued to soften into the second half of the year. So the economy is slowing down, no doubt about it. Then we get to Friday, and this thing called the SAHM rule. So what is the SAHM rule? Professor Claudia SAHM was on Bloomberg this morning at 8:30 when the jobs report came out. So she got to talk about the rule that she created. And it's pretty interesting. There's a lot of math involved in it, but the bottom line, the early stages of a recession are signaled when the 3-month moving average of the employment rate is half a percentage point or more above the lowest 3-month moving average of the unemployment rate over the previous 12 months. So if you're interested in the math, go take a look at what the SAHM rule is. But the bottom line is the SAHM rule triggered as of today. And that basically means it has 100% accuracy, the SAHM rule. So we are almost definitely already in a recession. Unemployment kicked up to 4.3% from 4.1%, which was expected, which it was 4.1% last month. It kicked up to 4.3, which may not look like a lot, a 0.2 move, but it's a lot. We already had the manufacturing index below 50, not good. And then non-farm payrolls, so the new payrolls that came in was only 114,000 versus 175,000 expected. So they expected a whole lot more jobs to be created than did get created last month. So you got unemployment rising, new jobs being created decreasing, manufacturing decreasing, all bad news, and finally bad news now is bad news for the stock market.
Like it's really, really bad news.
Yeah.
It's not kind of bad news.
Well, it's overwhelming. So the idea for months has been bad news means the Fed's going to cut rates. And so that means the stock market's going to go up when the Fed cuts rates. At some point, if the news is that bad and the Fed is cutting rates, it's because the stock market is collapsing, and that's why the Fed is cutting rates. And it's very possible that we're seeing the beginning of that right now. And so why would that happen around this time of year? If you go back 10 years, so this is off a stockcharts.com site. You go back 10 years, this is the S&P 500, right, our C fund. The percent of months where it closes higher than it opens. Okay? So here we are at the beginning of August. So in the last 10 years, August has only been a positive month 44% of the time. Okay, September 33% of the time. So if you're in Vegas, those odds aren't very good. I mean, you definitely want to be in the stock funds in the S&P when the odds are 80 to 90% in your favor, right? Not when it's 44 and 33% in your favor. If you're doing things based on seasonality. So not unexpected, we've been talking about the potential of a summer correction for a long time, and we put up charts quite a bit from Jeff Hirsch at the Stock Traders Almanac. This year, 2024, I mean, this is all election years, going back to 1949 to 2023. Right? So this is the average of all just election years. And you can see August to the end of October, beginning of November, this is where the election is, and we almost always get a rally into the end of the year. But the summer almost always, is flat to down. And you only ever get, say 8% for the year. That's a good year in an election year. We're already up here, 18%. We had a huge move. This is probably the biggest move in an election year. I have to go back and look at the numbers, but it's probably one of the biggest moves in an election year that we've ever had. So to expect some kind of flat to sideways to down into October and then a big move at the end of the year is very likely something like what we're going to get. All right. Okay, TNX. This is a good one. This is an important one. Okay, this is the foot stomper. So this is the 10-year yield. The Fed had been cutting rates. Yield had been coming down into 2020. Okay, from there we had the Fed started raising rates, right? When the Fed raises rates, it's really raising the 2-year and below interest rate, but it matriculates into the longer end of the yield curve, which is the 10-year. But we had this 1, 2, 3, 4, 5 Elliott wave pattern into 5% on the 10-year yield. Okay, so that's back, if you remember, last summer, maybe a year ago, everybody's talking about, hey, I can sit in treasury bonds and get 5% and not worry about the market going up and down. And that's great. No risk. Everything's great. Go out and buy treasury bonds. And that's true. You definitely could have done that. You could have got locked in a 10-year treasury bond. You would have gotten 5% a year for 10 years and then gotten your money back at the end. So we peak at 5%. Then we come down. We recover back up to lower highs, right? And we start rolling over again. Okay. So this 1, 2, 3, 4, 5 is a 1. We should get an ABC correction that takes us down somewhere in the neighborhood of the prior 4 wave. That's the 2. And then we should get a 3, which means rates are going much higher eventually. Okay, that's what the chart projects. In the short term, the yield is inverse to the price. So if you take this as the F fund, let's say, what should I do in the F fund? As yield comes down, the price of the F fund goes up. So if we were talking about this, we've been talking about it for a while, but we're talking about it last week. If yield comes down because the Fed lowers rates, but the economy does not collapse, then you get yield kind of somewhere down here in this box, right? All I did was do the length of this line, make the same as the length of this line, which gets me to the top of the channel, and the wave 4 here, the bottom of the channel. So somewhere in here is where is the minimum that rates come down to. If the Fed starts lowering rates because the economy is tanking, yield can come all the way down here to this dotted red line, to the top of the 1, before the Elliott wave count is no longer valid. But the big number, the really important one is this 1.618. Because a lot of times a 1, 2 comes back to that 1.618 retracement level. So it's possible you could see 10-year yield down there at 2.25%. Okay, so the initial target is like right here. You could get that'd be really low. You could get down there, and anything below here everything's coming off the rails. So that's kind of where we are. This one I think is interesting. It didn't update for today because it's a weekly chart, but it's the 30-year fixed mortgage rate. Okay, so it's very similar to the 10-year. Same kind of thing. This 1, 2, 3, 4, 5. Right. We had rates up here at about 8% back in October last year, and then mortgage rates have come down. As of today, they're going to come down a lot. The 30-year rate, 30-year mortgage. So say we get down to next week, we could be down to 6.5%, which would be great. you could get down to 6% easily. The question is if rates get down to 6% and housing price does not explode to the upside, it's probably the last best time you're going to have to get a relatively low rate. Because just like the 10-year yield, this is a 1. Whenever we get to the 2, wherever that is, that's going to be the lowest interest rate you're going to get on housing for a long time. Okay. And this, I would probably say forget about it. Mortgage rates down at 3% like they were. You're never going to see that again.
I would say never, maybe not in our lifetime.
It's not in our lifetime. And in the, what do we say? Possibility versus probability?
Yeah, the probability is extremely low.
It's pretty low.
Extremely low. Anything is possible, folks.
Yep.
I learned that all week long.
Yeah. Okay, C Fund. So 3 weeks ago, we put up this chart. We talked about the importance of a bearish engulfing candle, right? You got that red candle that absorbs the whole prior week's green candle, right? And we see that at almost every major top since the top in 2022. So it's a big red flag. Not to say that it can't turn around, but it's a big red flag, and that's why we're talking about it. And then last week we put up this one, the 20-week moving average line, and the 5-week moving average line is that black line right there. So whenever we get back above the 5-week, price finds support there, right, all the way along until it breaks below it. And then that's when the corrections start. And last week, we broke below it, right? So it's it adds to the red flag. The previous week was a problem because it was a bearish engulfing candle. And then last week, we got below that 5-week moving average line. And then as of today, it's Friday at like noon, we are sitting right on that 20-week moving average line. Okay. So on the one hand, everybody's freaking out because the market is down really big today, and it has been for the past 2 days. But if you step back and look at it for a second, can we get support like we did back in April at that 20-week moving average line? Absolutely, we can get support there. We get support at the 20-week all the time, right? If we break it, like we did there in January 2022, that's a monster red flag. Okay? So I'm not saying I would go out and sell everything. If I'm looking at this on a weekly basis, I'm not selling here. Right? From a weekly perspective, I'm not selling here because if you get support there and it keeps on going, that's great, and that's consistent with the overall trend. It's still in a bull trend. So on a weekly basis, you're looking really closely at it right now, and that's how you would make decisions. I mean, you're actually at a point where you have a low risk entry. If you bought the C Fund here, the potential upside is huge. The potential downside is really small because if we got a close below the 20-week, you would just sell it. So your risk is like that much. Your potential upside is a lot, right? It just depends on what chart you're looking at. S Fund, we had this triangular consolidation. We had a big breakout. It was great. It failed. It happens. It was a failed breakout. Same as this. That was a huge breakout to the S Fund, and it immediately rolled over and began that 40% drawdown there in January. So the breakouts fail, and S Fund is definitely a failed breakout at this point. I Fund, talking about the same thing here for weeks, if not months. You got that 82 level. We had a triple top back in 2021 at 82. We tried to get above it here several weeks, tried to get it above it here. Talked about how we kept getting higher lows, right? And it gave us this trend line. And everything was great as long as we kept putting in higher lows. We would eventually get above 82. And if we dropped below that trend line, we had a problem. Now we have a problem. This because you never know until you know. So now it's a big sell trigger. If you were in the I fund with the expectation that you're fine, you're gonna keep putting in higher lows, and eventually you're gonna get above 82, this changes that whole dynamic. And then the F fund, we've been talking about this for a long time. This was the top of the F fund. We came down in a 1, 2, 3, 4, 5. We should have an A, B, C recovery and then start going down again. But in the short term, the F fund just broke out. We got a really good neckline right there. And this week it broke out. So you got a left shoulder, a head, a right shoulder, and this is the neckline. And this week we broke through the neckline. So as rates go down, the F fund goes up. As rates go down, the rate of return of the G fund goes down. It can't be negative, but as interest rates come down, the rate of return of the G fund goes down, the rate of return of the F fund goes up, and all the stocks are collapsing. So that should pretty much tell you what you should be thinking about for your TSP. All right. Questions?
Questions. If you have any questions, you can hit us up on in the comment section, wherever you find this video, all the social media channels, YouTube and everything. We keep track of the comment section as best we can. If there is no comment section wherever you found the video, you can shoot us an email at support@growmytsp.com. Hope you guys are liking the show. If you do, share it with your friends. Please.
Yep.
Hit that subscribe button, all that stuff. You guys have a good rest of your week, and we will see you next week. It's going to be a lot of fun coming up this week, man. It's always something.
It's always something. Always something.